Welcome back to Alpha Recap. Kristen here. Markets closed after a busy Thursday, and we've got a lot to unpack. Today's tape was driven by two tech headlines that pushed AI and cloud narratives back into the spotlight, plus a string of policy and ETF flow stories. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks, great to be here. In short, Alphabet signaled a big surge in capital spending into 2027, tied to what it called unprecedented AI demand, and Goldman Sachs raised its price target on Amazon to $325. Both stories pushed data center, cloud, and AI themes all day.
Let's dig into Alphabet first. What did they actually say about CapEx?
What really stands out here is the scale. Briefs referenced a near doubling of spending versus prior plans, roughly 117% higher in the way some analysts framed it. That kind of lift is about building physical capacity, data centers, networking, chips, the works. It's a classic trade-off. Big, multi-year investment now, which can compress free cash flow in the near term, while hopefully enabling a bigger AI revenue base later.
So that pressure on cash flow, what should people be watching as the story unfolds?
You want to watch utilization and conversion metrics. In plain English, how quickly those servers get used to deliver paid services, and how orders or reservations turn into real revenue. Analysts will also track guidance, margin trends, and any discussion of order book conversion. If utilization lags, you'll see earnings bounce around quarter to quarter.
Right.
And on the flip side, Goldman's move on Amazon, that price target bump, leaned directly on cloud strength. The bank is basically saying AWS is the growth engine and that cloud momentum materially improves the company's revenue mix and margin profile.
So when you put the Alphabet CapEx push and Goldman's Amazon view together, what was the market signal?
When you step back and look at this, the market read it as renewed conviction that hyperscale cloud platforms will both buy massive AI infrastructure and find ways to monetize it. That shifted attention and flows toward data center real estate players and AI chip suppliers. Think the companies that sell racks, cooling, interconnect, and silicon. It also meant more concentration risk in some ETFs. A handful of big cloud and AI names can dominate index exposure.
Okay, shifting gears a bit. Policy and regulation were also big today. What happened at the industry level?
The Investment Company Institute kicked off its leadership summit in Washington, D.C., with senior industry figures on stage. Names like Mary Barra and Senator Ted Cruz appeared. Day 2 was set to feature Kevin Hassett and the CFTC chair, Michael Selig. Those panels matter because regulators and industry leaders can drop hints about fund structure rulemaking, derivatives oversight, and market structure policies that affect ETFs and mutual funds.
Right. And the other thing is, there was also that FCC comment about Disney, correct?
Yes, the FCC chair publicly said the White House did not pressure him to open a review of Disney. That narrowed a political overhang that had been creating short-term uncertainty for the media giant. Political headlines can spike volatility, so removing one like that calmed a bit of the story. Let's talk flows. That was another big part of the tape. The Bitcoin futures ETF fell down just over 1% on very heavy turnover. About 126 million shares changed hands. And a leveraged small-cap inverse ETF finished up about 2% to roughly $5.30 on about 190 million shares. High turnover in those products tends to amplify intraday volatility and signals active tactical or hedging demand.
That kind of volume can really move things.
Exactly. Heavy activity in leveraged and futures-based funds interacts with derivatives plumbing and market structure, the very topics getting discussed at the ICI summit. So regulators' remarks could be an important catalyst for repricing risk premia in those products.
Quick hits on corporate news. Anything stand out?
HFCL reported its best ever quarter and year, with an order book exceeding about $2.3 billion, which speaks to backlog visibility across defense, telecom, and digital infrastructure. And in healthcare tech, Provider Trust and JD Palatine announced an integration to automate pre-hire eligibility. That news moved the company's shares by about $1.50. Those are reminders that backlog conversions and product integrations can move both revenue outlooks and short-term stock action.
Honestly, I was a bit surprised by this one.
Legal items mattered too. Investors in EOS Energy Enterprises faced a securities class action deadline on May 5, 2026 for certain purchase windows. Those kinds of deadlines can create short-term liquidity pressure as eligible holders decide whether to participate. And on the policy side, responses to Department of Justice reports, like the one from the Family Research Council, are a reminder that reputational and legislative debates can lead to follow-on legal or policy actions that markets may need to price. Putting it together, a few patterns stood out. First, the AI-driven capacity build-out is back as a multi-quarter structural theme. Capital spending at big platforms is refocusing attention on physical infrastructure. Second, analysts are actively reworking valuation inputs and price targets, producing re-rating events. Third, high retail and tactical ETF activity is making short-term positioning and hedging very active, which increases intraday liquidity and volatility. And fourth, policy and regulator appearances are a live lever that can soothe or amplify volatility, especially for derivatives and fund structure-sensitive products.
So what should folks be watching when the market reopens?
Watch the ICI Summit Day 2 remarks from Kevin Hassett and CFTC Chair Michael Seelig. Anything concrete on derivatives oversight or market structure could move ETF and futures products. Look for Alphabet follow-ups on 2027 CapEx plans and any utilization or timing metrics. Expect more analyst notes on Amazon and AWS as firms refine assumptions behind that $325 target. Keep an eye on whether the Bitcoin futures ETF and leveraged inverse funds sustain heavy turnover. That'll indicate continued tactical demand. Finally, watch whether HFCL converts backlog into profitable contracts and whether EOS Energy Enterprises has any filings ahead of that May 5th deadline.
Give us your top 3 takeaways in a sentence each.
1. Large tech CapEx tied to AI is shifting the narrative from pure software toward physical infrastructure, which changes who wins in the ecosystem. 2. Analysts are actively repricing cloud and AI names. Expect more price target moves and concentration in passive flows. 3. Elevated ETF turnover, especially in leveraged and futures-based products, is increasing short-term volatility and making regulatory comments especially consequential.
Great. Quick reminder, this discussion is for informational purposes only and is not personalized investment advice. Analysts note trends and data that participants may consider when doing their own due diligence.
Yep, data and themes, not buy or sell calls. If you want to dig deeper into any of these headlines, we'd love to hear from you.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. Catch you next time.